Good morning and welcome to the Foundation Investor webinar for the Talaria Global Equity Fund. I'm Joel Beebe, here with Chief Investment Officer Chad Padowitz, and thank you for joining us at this time. We appreciate these are exceptional circumstances for everyone. Our purpose at Talaria is to help people and communities enjoy a more certain financial future, something we've been doing for 15 years. Today we wanted to provide a sense of what's happening in the equity market and how our process and market volatility is creating opportunities for investors. Before we commence, some housekeeping. You'll note the disclaimer on the screen regarding today's webinar, and a reminder that this webinar is for wholesale investors only and is not to be considered as financial advice. Chad intends speaking for approximately 10 minutes today to leave plenty of time for Q&A. You can submit your questions on screen via the chat box. Similarly, if you're seeing a play button on your screen, please press play now to start the stream. With that, I'll hand to Chad Padowitz. Thank you.
Good morning, everyone. The only time we've previously seen such a high level of elevated volatility alongside market declines was during the GFC. Now it's in periods of very high levels of uncertainty when people are prepared to pay a very high premium to get some level of certainty. What you're seeing on the screen now is the light blue line is a measure of the VIX, which is a proxy for market uncertainty, and blue line is the market, is the market movement. Now what you can see is this payment for taking risk, this light blue line, stays elevated for an extended period of time. So much so that it went above 40 in October 08 and stayed there up until April 09. And this allowed our income generation to become significant into the fund, and we earned that over both 2008 and 2009. Of note is when the VIX does go through 40, the market happened in 2008, the market was down 30%. However, if you were only faced with the opportunity to invest into the equity market, you subsequently saw another 34% decline until the market ultimately hit bottom. Our process, which generates a significant amount of income, allows us to benefit from that without having to take a view on the actual market direction. So much so that $100 invested in October 08 became $114 in April 09, whereas a similar investment of $100 into the index actually dropped to $84. As you can see now, the level of uncertainty today is commensurate with that in 2008. Once again, the payment that we are getting for committing to buy shares that we want to own is exceptionally high. We similarly expect this period to be elevated and extend for an extended period of time, given the unprecedented economic dislocation that's happening from this current pandemic. Further, with the majority of countries in partial or full lockdown, where the market does ultimately bottom is unknowable. Our process, though, allows us to generate very strong returns from any new capital invested into the market today, which, as counterintuitive as it may seem, is actually lower risk. Looking at, it's not just about volatility, it's also about the equity opportunity that is available to us. What we can see in the chart here is historically approximately, and also up until about a month ago, about 10% of the equity market had a PE of below 10. Now there was a reason these companies had low valuations. It could be structural risk, they leverage a whole range of reasons why they were of a certain quality and business prospect that they were actually at a very low valuation. That number has dropped, PEs below 10 has significantly increased by about 25% higher. So around 35% of companies now are in that. But importantly, of that 25%, they're of far better quality of balance sheet, far better quality of businesses, far better cash flows, we're able to substantially increase the quality of companies we can access, not just at a far lower price and at a significant premium, but we're able to buy companies that otherwise historically would have been less available to us at such attractive valuations. I'm going to run through you now an example of a current trade we just did last week to give an example of how this high level of volatility and quality of company we can now access. So the company I'm going to talk about is Roche, which is the world's leading oncology pharmaceutical company. On the 19th of February, on the 19th of March, we looked at an opportunity where we could buy Roche at $290 Swiss francs. As a comparison, a month earlier, it was trading at 350. We subsequently decided that this is a company we wanted to buy, but we were able to commit to buy it at 240. So very importantly, it now needs to drop a significant amount of money, which I'll come to in a second, but the premium we're getting for agreeing to pay 240, considering it's trading at 290, is 15.5 Swiss francs. In comparison, just a month earlier, we would have had to agree to buy the same company 100 Swiss francs higher at 340, and only have got paid 6.3 Swiss francs. What that means in return is we're now getting a 25% return per annum versus only 11.3 prior. Importantly, the buffer against loss has substantially increased. So Roche now needs to drop from the current more depressed price another 66 odd Swiss francs before we encounter any loss. And that obviously compares to a far lower 17 just a month ago. What that means in percentage terms is instead of a 5% buffer against the loss from a month ago at a higher strike price, we're now moved up to 22.6%. The company will end up owning, if we do end up getting it, will also, as would be expected, pay a far higher dividend yield, as well as a valuation of 10.9 times versus something that was trading at close to 17 times a month ago. Now, to put that in perspective, the US government debt is deemed by the bond market to be riskier than the debt of Roche, which is quite a remarkable thing. And that goes to the quality of the company, the strength of the balance sheet, the stability of the cash flows. But yet the market volatility is of such an extreme nature that notwithstanding what we believe to be a very low risk, high quality company, the return that we can get has more than doubled to 25%. The buffer against the loss has gone up by a factor of 4. And if in fact we get the share, and we do actually hope to get the share, the valuation from that point will be 50% higher than the price we get it. That will also yield more than 4 times what's available from similarly government debt. And that's briefly is the Talaria opportunity. Our process benefits from volatility, from both the income we generate to the valuations of companies we can get and the quality of companies we can buy. We haven't changed what we've done for the past 15 years, but merely the benefits of what we do now, the benefits of that are quite extreme. The income we are going to be able to generate and that we are generating currently is going to allow a far greater level of certainty for both new and existing clients into what is currently a very uncertain environment. On that, I will now move on to questions and answers.
Thanks, Chad. Thanks for the many questions coming through online. We'll kick off with some that have come through, so thank you. Keep them coming as well as we're speaking. Chad, questions come through from a couple of investors asking, how do we know when we're investing that in these times we're not catching falling knives?
Yeah, that's obviously a very good question. I mean, markets are very volatile, and there's always a question of things like value traps and so on. I think it's important to realize that, one, we are looking to buy shares. We are committing to buy shares that, one, have dropped 25 to 30% already, but we're only committing to buy them a further 25 to 30% lower than the current price, and getting paid a substantial premium for that. Secondly, as I touched on Roche, the companies we're looking to buy and own are very high quality in terms of balance sheet, in terms of liquidity, in terms of solvency. We are buying, Roche is the leading oncology provider in the world. We know we have companies like the leading drug distribution business, leading electrical low energy voltage business. So we are looking at buying leading businesses that have very strong balance sheets and very defensible businesses that are needed in the economy that will come after this period of uncertainty.
Thanks, Chad.
Sure.
Another question we've received relates to our geographic exposure. At the end of February, we had less geographical exposure to the US versus the rest of the world. Has that changed in the last few weeks? And what's your view?
Yeah, thanks, Charles. Look, importantly, we are bottom-up investors. The shares we own are a function of their bottom-up attributes. We are not top-down geographic investors. So where the opportunity is where we're going to end up owning the company. It just so happens a lot of the companies that we like and we think are very attractively priced happen to be in different jurisdictions, and that's going to drive our geographic exposure.
Thanks, Chad. A couple of questions on currency. Firstly, how's FX sort of impacting the portfolio over recent times?
Yep.
And how do we manage any currency risk?
So the fund is unhedged, so all of our assets, substantially all of our assets are in the underlying investments we have, which would be across developed market listed currencies. So that would be US, Euro, Pound, Swiss franc, and Yen predominantly. We will benefit as the Australian dollar declines. Now that depends against which currencies. So obviously the US has been particularly strong. The Aussie dollar has not declined as much against some of the other currencies, which have also been quite weak. So there's a range of different moving currencies, but in short, a weaker Australian dollar is beneficial for the fund's returns.
Thanks, Chad. Just regarding the liquidity of options, obviously a key component of our strategy.
Yep.
Can you just talk about liquidity in the options market?
Sure.
Please.
So first I'll highlight that every option we write, one is 100% cash back, so there's absolutely no leverage. Secondly, it's exchange traded, so there's no counterparty risk. We only trade on the market. Now, but more importantly, specifically to your question, Joel, or the question I was asked, is we are a liquidity provider. We are naming our price right now. People want certainty. They're paying a substantial amount for that certainty. So the liquidity is as much as we're prepared to offer rather than the other way around.
Great, thanks. Just some questions coming in about our market exposure as stocks have declined, how our process works in that situation, what we're seeing.
So, yes, so we sell put options as a means of entering into positions. As the market declines, you should expect some of those positions to become equity. That is slowly happening. A good example, because it's very commensurate to what's happening in line with the GFC. In the GFC, we entered late 07 with under 60% market exposure. I think it was around 57%. The fund then reached its highest level of market exposure in the low 80s at the end of the first quarter of 09. So that's sort of the trajectory of how things happen. We slowly get more and more equitized, which is what you want, because as the opportunity set increases, as the valuation of equities drop, you want to get more and more of those equities so you can substantially benefit when they ultimately recover. We expect that to be in line, the current environment to be in line with that. So we are slowly increasing our equity market exposure in this current environment.
Right, which goes to the maxim of buying low.
Yep.
And
The
selling high.
process needs to be having more market exposure as the opportunity set increases, and
Right.
vice versa.
Thanks.
Yeah, that's right.
Some questions coming through. Just we've seen some dislocation in fixed income markets. It's not a market that we're directly involved in, but has that impacted sort of the change in high yield spreads at all had any impact on your ability to buy shares, or is that only a phenomenon that's in the fixed income market?
Yeah, well, there's a few things about the fixed income market. One is it's a source of return that people have gone to, alongside dividends which have been dropped. But fixed income, the yields have been very low and the spreads have been very low up until most recently. I think people are seeing that the risks, capital loss is a lot higher there than it absolutely was. Equities are a lower portion of the capital structure, so it's fair to say that if there is dislocations on the fixed income side, that can create extra volatility on the equity side, and it should. We are a beneficiary of that because we are looking to buy some of those equities.
Thank you. Any other sort of sectors or stock-specific examples you can provide of recent times, things that may have been somewhat expensive over recent years, but are now more attractively priced? Yep.
So obviously, other than the Roche example, which we gave, I'll give another example of money we've committed to we've deployed around 6.5% of the fund's capital into the market in the last 8 trading sessions, and we've obviously generated the returns that we showed you, greater than 25% with a 25% buffer against loss. Another example of a company that had those attributes would be Swiss Re. Swiss Re is one of the largest reinsurance companies in the world. We say they're in the business of staying in business, very high credit rating, 200% capital buffers. That company has dropped around 40%. The shares are now trading at 60 cents in the dollar. The dividend, which they just recommitted to last week, so this is up-to-date information, is over 10% on the current share price. So that's an example of a company we can now buy 40% lower than it was, 60 cents in the dollar, at a greater than 25% discount to its current price to when we would commit to buy it and get paid over 25%. There were a range of other examples. Touch on one more, Medtronic, one of the largest medical equipment companies in the world, also has a balance sheet and credit rating similar-ish to Roche. They have also dropped significantly. That is also one that we're able to buy a 25% return at 25% down buffer. So there's a lot of very, very high quality companies that we are getting these exceptional returns and buffers on.
Just a more broad economic question. A lot of press talking about recession and words like that, doom and gloom. Just your thoughts on, will this end in a severe recession? And what would be the impact on the portfolio from here?
Yep. Look, one, we don't forecast market movements. It's not what we do. We don't think there's a very good track record in anyone doing that. Similarly, I think it's very difficult to forecast economic outcomes. I don't know where the economy actually bottomed. When it actually bottoms, I do know it will. Importantly, and this is, goes to what we're doing, the companies we're investing in, we are absolutely laser focused on understanding that where our equity sits in the capital structure, their solvency, their liquidity, their defensible business and cash flow, and then we're getting paid a substantial amount to compensate for this risk. So this risk is unknowable for us, but it's unknowable for everybody else. But people are paying for that risk. We're getting that. And if we get the shares we have committed to buy, they've got those defensive quality attributes. So whatever the situation is and however long it goes, we think those combinations will stand us in very good stead for our investors going forward.
So there's a significant gap between the price we'll be buying shares that we're getting into now versus where they're trading now, which provides a nice sort of cushion.
Yes, there certainly is, and I think it's something I just highlight, not just that gap, but the payment of that has allowed, give an example, when we invested in October 08, 7 months later in April 09, when the VIX actually subsequently went below 40, we had turned $100 into 114, where the market had gone down to $84. So that just shows that when you're committing in a period of extreme uncertainty, when you're getting these levers of return that we're getting, even when, regardless of not knowing what the future holds, because we don't know and we didn't know then either, we were still 30% higher 3 years later than the market when we were committing capital back then. Yeah.
Great. No, thanks. Another question coming through just in relation to the oil sector. I guess it's topical just with, we've seen the decline in the oil price. If you could just comment on our exposure versus historical and where we see that today.
Yeah, so some years ago, probably more than 5 years ago now, we did have a higher exposure, reasonably high exposure to the oil sector. We subsequently got out long before the oil price dropped because of concerns about the resiliency of shale, actually, which turned out to be a good thing because it was a very poor performing sector from that point. We have a very small exposure currently to a company called Canadian Natural. They have a cost of production on the majority of their assets of around $13 a barrel. 13. So they have recommitted both to their dividend last week and to their financial resiliency. We actually slightly increased our position into that last week. It was part of the 6.5%, and that return was obviously of an exceptional nature given the volatility. But more broadly, we're currently looking at all sectors and opportunities and companies. Oil would be no different. But we don't have a specific current preference for that at the moment.
We go where the value is,
Yes.
bottom-up fundamental research.
Indeed.
Yeah. Great. Just regarding option premium, could you explain how the option premium we're receiving now manifests into return going forward into the portfolio? For every option that we buy down, we receive the premium. It obviously doesn't turn into instant performance that day.
Exactly. So obviously the share movements is an instantaneous thing, the shares you own, and that's going to happen on any shares you own. The option premium is somewhat different. The option premium, we receive the money today, so we commit to buy a share sometime in the future. We receive the money today. In terms of performance into the fund, that takes time for the period of the option to expire. So if it's a 3-month option, sometime over that 3 months is when the income gets fully earned. To put that in perspective, we have generated over 2% of option premium for the month of March. None of that is currently in the performance. That will show up over time.
Right.
Just put things in perspective, the entire calendar year 2019, we generated 6% of option premium. We've already done more than 2% for the first 3 weeks of just this month. So you should expect that level of second lever of return, which is income, to be a significantly beneficial number going forward.
Thanks, Chad. I think that highlights the differentiated return profile and sources of return in our portfolio that aren't reliant on the market recovering in any great hurry. So, no, appreciate that, Chad.
Okay. Thank you.
Well, with that, we're approaching time, and thanks for all your questions and for joining us today. Of course, if we didn't get to your question or you have any further questions on the presentation or our portfolio, do reach out to us directly. We appreciate you joining us this morning. We know it's exceptional circumstances and trying time for many investors and everybody and their families. So be safe and well, and thank you for joining us.
Thank you.